Okay, so now let's go to part 2 of the chapter on the equity market and stock valuations. In the last class, we studied the one stage and two stage model, right? The two period model, and we also derived the dividend growth models, right? That's the P0 equal to the D1 over R minus G, right? D1's dividends will be paid in the next period, right? So D0 times 1 plus G, right? R is required rate of return, G is growth rate of dividends, P0 is the price of the stock on time 0. Now we will study something about equity market, and we will study our extension of the stock valuations in today's class. Okay, so for the recent weeks, because our panic of the coronavirus, right, the COVID-19, right, so the whole market is very volatile, right? You can see in the past 2 weeks, right, the stock price up and down very frequently, right, like a roller coaster, right? It's not just for individual stock, for the whole index, for the whole market. For example, Dow Jones, right, the index you can see here, right? Just for a few days, right, it loses more than 6%, right, more than 10%, more than 14%, right? But also for some days, it's also recover very soon, right? So up and down, right, very frequently means what? Means very risky, right? Risky. So for our stock, right, there are two types of stock in the shareholders' equity, right? We have the preferred stock and common stock. What's the feature of the common stock? If you hold in a common stock, you are owner of this company, right? You are the true owner of the company based on how many shares, right, you hold. You have the proportional voting rights, right, for this company, right? This one we call proxy voting, right? The more shares you hold, right, means you have the more voting rights, right, for this company, right? So you can choose what? You can choose the board, right? You can choose the board members, right? Then the board will select chief executive officer, CEO, and the other management teams, right? So you are going to vote for the board members, right? And the board will select who will work for you, right? So all these guys, just your Just your agent, right? You are the true owner, right? The common stockholder are the true owner of the company, right? The CEO and the other guys just the agent working for you, right? For the common stock, they also holding the other rights, right? For example, based on how many shares you hold, you can proportionally declare what? Declare the dividends, right? If you have a residual income, right? Our common stockholder can share what? Can share the dividends, right? Proportionally based on how many shares you hold, right? And also after creditors and the government are paid, right? What's left after liquidations, right, is based on how many shares you hold proportionally, right? The more shares you hold proportionally, right, you are going to claim more remaining assets, right, during the liquidations, right? And also you have the pre-exemptive right. What's a pre-exemptive right? Right, you may see some questions about this concept, right, in the test, right? So you have a first shot at the new stock issue to maintain the proportional ownership if desired, right? What that means? For example, right, you holding 100 shares of the stock, right, in a company A, right? Company A issue total what? Total, for example, 5,000 shares, right? So what's your ownership in this company will be 100 over 5,000, right? Equal to 1 over 50 equal to 0.02. So you own 2% of what? This company's ownership, right? Now the company A decide to issue what? More stock shares because they want to expanding their business, right? They want to borrow more money, so they try to issue new shares, right? They try to issue what? Another 5,000 shares, right? Outstanding to a market, right? So that will be total 10,000 shares, right? And if you're still holding 100 shares, right, your ownership, right, will be only what? 1%. It's not fair to you, right? So how can you still maintain the same ownership, right? The company A, when they try to issue more shares into the market, they will automatically, right, give you the same proportional shares, right, based on your previous holding, right? So you get another what? 100 shares, right? So you have the total 200 shares, right? Then divide by the total 10,000 shares, right? Your ownership will be still 2% in this company, right? So once they decide to, issue more new shares, right? Your proportion will be not diluted, right? You have a first shot at the new stock issue to maintain what? Maintain the same proportional ownership if desired, right? However, if you are not willing to do that, right, you can decline his offer. Right? You can decline his offer. And also keep in mind, even stockholder can receive dividends, but dividend is not a liability of the firm, right? And dividends will be declared by the board, right? Not every firm will pay dividends, right? For example, for tech companies, right, technology companies, right, they usually not declare any dividends, right, because they are expanding very fast, right? They need to use the cash, right, to support expansion, right? They don't have the enough residual income, right, to pay as dividends, right? So for these firms, there will be no dividends. Many firms on the Nasdaq, they will pay no dividends, right? Even for some big giant company like the Amazon, right? It is a new company, right? In the history of what? Technology companies, right? I mean, for the Tesla, same, right? So even you see them large market cap for these companies, right? But they are still very young, right? So they don't pay any dividends, right? All the money from income was support for their what? Expansion, support for their operations of the business. So the companies will not go to bankruptcy, right? If not declare any dividends, it's totally okay, right? So it will based on a board, right, to decide whether they will pay dividends and when to pay these dividends. And dividends also not like a coupon, right, in a bond, will be not considered as a business expense, so they are not tax deductible, right? The dividends will pay a capital income tax, right? And for the preferred stock, right, it's not same as what? Common stock. Preferred stock don't have any ownership, right? So they don't have what? They don't have the voting rights, right? So if you're holding the preferred stock, you will receive the dividends passively, right? But you guys cannot vote for the board, right? And also preferred stock, right, receive the fixed, or you can say the constant amount of what? Dividend every period, right? So dividends will be the same, right? Every period, right? Also, like we mentioned before, right? dividends are not a liability of a firm, right? So the preferred stock dividends can be deferred, right, in future, or you can say forever. Most preferred stock dividends are cumulative, right? Any missed preferred dividends should be paid, right, before the common stock dividends can be paid, right? So you can say in the order of the priority of the payments, right? First one get paid is the what? The long-term debt holder, the bond holder, right? So these guys will be paid, right? The coupon will be paid as first, right? Then will be the tax, right? Will be the government, right? Then next one will be the preferred stock. Last one is what? Common stock, right? So even common stock is owners of the company, they will be what? They will be paid and last, right? They only claim residual what? Residual income. What left finally will be for the common stockholder, right? So that's why they have the right to choose the board, right? I mean, they must to guarantee, right, they will be paid in the future, right? So they will have the right to compensate with such risk, right? So they will choose the board. The board should be the members, right, can truly work for them, should be ethically, right, ethically working for them. The preferred stock generally does not carry voting rights, but only receive what? Only receive the dividends, right? And there's a difference between the dealer and broker, right? Dealer trading with the inventory for a bid and ask price, right? So dealer itself, right, has inventory, right? So the dealer of the stock in their own accounts, right, they holding what? They holding the stock, right? But brokers, they don't have any inventory. They only going to match the buyers and the sellers, right? And they will charge a commission, right, for a fee, right? So dealer is buy what? Buy low and what? Sell high, right? The price difference will be their what? Will be their profit, right? So they will buy something in the inventory and sell to the what? Public, right? The difference of the price between the bid and ask will be their profit. But for brokers, right? They don't have any inventory. They only match the buy order and the sell orders for our commissions, right? That's the difference. And you can say in the NYSE, right, New York Stock Exchange and Nasdaq, right, you can see there are many floor traders over there, right, and take the course, right, to trade in the stock. And there are more than 1,000 license holders, right, for the commission brokers, right, specialist floor brokers, and for floor traders, right. They are working very actively on a stock exchange, right, to working for their clients, right. And for the NYSE, right, is a primary stock market, right, and many big companies are listing the stock on the New York Stock Exchange, right. Compared with the New York Stock Exchange, we have also index, or you can see the marketplace, right, for the small companies and technology companies, right, it's the Nasdaq, right. Nasdaq is not a physical exchange, it's a compute-based quotation system, right. It's only working for the small and emerging companies, and they use electronic communication networks, right. There are three levels of information in the Nasdaq, right? Level 1 is for the media quote, right? Level 2 is for the view quotes, right? It's from the registered brokers and dealers, right? The last one is the highest level 3, right? It's only for the dealers. Large proportion of technology stocks are listing on the Nasdaq, right? Especially some medical firms and the small IT companies, right? They selling and buying stocks on the Nasdaq. So you can go over our, these stocks, right? You can go to the, Nasdaq website, right, to check the electronic communication and networks for Nasdaq. So please go to the Yahoo Finance, or you go to the Bloomberg, right, website. You can see the stock price every day. So let's show our examples to you, right? So now let me show this stock, right? It's a Zoom, right? Zoom video communication. I think you know this company very well, right? Especially during these 2 weeks, right? And we use the remote teaching, right? So many professors adopt Zoom, right? Zoom is a very good company, right? You can do the video conference, right? And it's very convenient, right? So after the outbreak of the coronavirus, right? So many school close the campus. They choose the remote teaching, right? So the Zoom actually becomes a very popular platform, right? So you can see the price of the Zoom also increasing, right, with the time of the coronavirus panic, right? So for me, I'm holding the Zoom, the stock, right, from last week, and also I bought what? Bought the Tesla, right? But the price I bought the Tesla is not very, cheap, right? It's actually not very low, right? So even with this week's recovery of the Tesla stock, I don't make too much return. But for Zoom, right, I holding for a whole week, right? So returns more than 20% right now, right? So you can say, let's take a look for this quote on Yahoo Finance, right? We have the opening price. This is the price when the market opened on 9:30, right? So what's the price on today's market? When Zoom begin to trading on the market, it's 140, $10, right? Last night, right? Last afternoon, to be more accurate, right? When the market closed on 4 p.m., right? The price of the Zoom is $135, right? So after one night, right? When the market opened, it dropped to a $140.1, right? Because before the market opened, right? That's a pre-market, right? And also after close, there's a post-market, right? So even you cannot do the trading, right, from your terminal, but broker and dealers still doing the trading. So that's why the price, from the last day will be different from the price open, right, today. And this is how many people, right, bidding for, the price, right, and how many people willing to sell the stock, right? Because now market is already closed, right? So you can see there's no trading, right, transactions available, right? And this is the daily, lowest price and the highest price, and this is the lowest price forward for 1 year, and this highest price for 1 year, right? So you can see the Zoom, right, actually increased doubled, right, from the lowest price for this whole year, and this trading volumes, right, trading how many shares, right, in total on the market, right? And this is how much total value of the total outstanding shares, right, outstanding on the market. And this is the P ratio, right, price to earning ratio, earnings per share, right, earnings announced date, and also ex-dividend date, right? So you can see the Zoom not announce any dividends, right? So Zoom not pay any dividend to the stockholders. Let's take a more closer look to the Zoom's price, right, for the past 3 months compared with the other two index. One's the Dow Jones, right? One's the S&P 500, right? So the purple curve is a Dow Jones index, right? Dow Jones index, and the blue curve is a S&P 500 index, right? And these candle bars, right? These candle bars, right, is our Zoom stock, right? So every candles represent the trading volumes, right, of the stock for every day, right? The bigger, candle bar, means more trading volumes, right, on that day, right? So more shares change the hands, right, on that day, right? You can see the red candle bar means the selling, right? Means the price is dropped, right? The green candle bar means the price go up, right? You can see in the past week, right? The June, surge a lot because what? Because the people think, more user were using the Zoom, right? Doing the what? Doing the remote, teaching or remote office conference, right? So that's why the Zoom price, right, increasing a lot, right, during the past week, right? Compare with our two index, two benchmark, right? You can see for the past 3 months, right? Zoom performing much better than our index, right? So it is a what? Bullish stock, right? Not a bearish stock. A bullish stock means the stock keep climbing up, right? So please go to the any stock website like Yahoo Finance or Bloomberg, right, to check the current stock quote, right, for the stock you like. Let's take a short quiz, right, for the topics we covered in the last class, right? In last class, we studied what? How to pricing a stock, right? Use our dividend growth models, right? For example, what's the price of a stock? If a stock is starting to pay be careful, constant dividends, $2, right, per year. What that means? If you receive a same dividend every year, this one is our preferred stock, preferred stock, right? And preferred stock pay dividends $2 per share, right? And also required rate of return is 15%, right? So what's the price of preferred stock? Will be the what? Preferred stock is a perpetuities, right? So we have the same dividends over what? Required rate of return, right? So that's the price you're willing to pay for this preferred stock to over 0.15. Next one, right? For the preferred stock, G equal to 0, right? G equal to 0. Next one, if the company starts to increasing dividends by 3% per year, beginning with the next dividend, right? What's the price you're willing to pay for this company stock, right? Based on required rate of return, right? It's 15%. If the dividends will be increasing by 3% next year, right? So what's the dividend next year? The D1 equal to what? Equal to a D0, right? $2, right, per share times what? 1 plus 3%, right? So 2 times 1.03 equal to $2.06 per share, right? That's D1. Our DGM formulas will be P0 equal to D1 over R minus G, right? D1 equal to 2.06, right? Required rate of return 15% minus growth rate 3%, and so our answer will be 2.06 over 12%, right? That's the stock price you're willing to pay, right? Based on the dividends growing with a fixed rate, right? 3% per year. Let's do one more questions, right? For a comprehensive problem. XYZ stock currently selling for $50 per share. The next expiry dividend is $2 per share. Growth rate is 6%. What's the expiry rate of return on this stock, right? So P0, right? This is the price now, right? So P0 equal to what? $50 per share. The next dividend is D1, right? Next dividends means dividends paid in the next year, right? Equal to $2 per share. Growth rate 6%. Right? Let's plug these numbers into our DGM models, right? The P0 equal to the D1 over R minus G, right? D1 equal to the 2, right? R equal to what? R is something you want to solve, right? G is given, right? 6%, right? Price is what? 50, right? So you solve the R. So we have the, R equal to 2 over what? 2 over 50, right? Plus 6%, right? So will be 0.04 plus 6%, right? So 4% plus 6% equal to what? 10%, right? 10%. Next one, if required rate of return on the stock is 12%, right? And what would be the stock price be? And what would be the dividend yield be? Right? What's the stock price now? Will be the P0 equal to the D1 over R minus G. Right? R is now is 12%. Right? G is what? G is 6%. Right? D1 is 2. Right? So 2 over what? 6%. Right? That's the price. Right? And how about dividend yield? Dividend yield is the D1 over what? Over P0, right? So for the given price per share, how much dividend you can receive is called dividend yield, right? So based on what you solved here, right? That's the P0, right? And use the D1 over P0, you can solve the yield. Right? You can solve the yield. Now let's try something, right? More complex, right? So we assuming the stock now, right, will take unusual growth, right? What's unusual growth? Means the growth can be different for different stage, right? Different period. For example, let's say these questions, right? The firm is expecting to increase dividends by 20%, right, in 1 year. Then increase dividends, right, by 15% for the 2 years, right? After that, the dividends will be increased with the same rate, 5% per year, forever, right? If the last dividends just paid at time 0 is $1 per share, based on this required rate of return, what's the stock price? You can see, first we can label our numbers right, into our cash flow diagram, right? You can see that's our questions about, right? You receive a $1 dividends on time 0, and these dividends will be increasing by 20% in the first year, 15% for the next 2 years. Then start from the third year, right? Dividends will be what? Growing with what? Same rate forever, right? So we have the 3 stage, right? This is stage 1, right? The growth rate of dividends is 20%. This stage 2, right? This stage 3. Okay? You can see these are typical, growing company. What's that, right? When a company growing what? Growing fast, right? They have a high growth rate when the companies were young, right? But when company getting, more mature, right? That growth rate slow down until they reach a what? Reach a, fixed growth rate, right? So for this part only, right, our growth rate is what? Is constant, right? But for these two stage, right, our growth rate are not equal, right? Not fixed, not constant, right? So how to solve these questions, right? So we will divide our calculations for what? For 3 stage. So we solve dividends for every year, right, based on this growth rate, right? So D0 equal to $1 after 1 year, right? What's the dividends? Will be 1 times 1 plus what? 20%, right? Growth by 20%. So it's equal to $1.2, right? $1.2. That's dividends you will receive on the time 1. How about time 2, right? It's growth by what? 15%, right? So 1.2 times 1 plus 15%, right? How about third year? Right? On third year, what's your dividends? Will be these dividends, right? Times 1 plus 15% again, right? So will be square, right? So the time 3 dividends equal to 1.2 times 1.15% square, right? You can see the next slide for that, right? D2 and D3, right? So D3 equal to $1.59 per share, right? And after times 3, right? Starts from times 3, our dividends will keep what? Keep growing with the same rate forever, right? So for this part, we can use our what? Use our constant, right? Constant growth model, right? Our constant growth model, right, has the model with the P0 equal to what? D1 over R minus G, right? So our D1 will be 1.59, right? That's the dividends paid on the times 3, right? Times what? Times 1 plus 5%, right? Over R. R is required rate of return, right? Then minus G, right? Let's see the calculations here. So continue from the times 3 and forward, right? The price for this part should be what? P3, right, equal to the D4, right, the next year's dividends over R minus G, right? So D4 equal to the D3 times what? 1 plus G, right? And R minus G. So you can say our P3 equal to a D3 times 1 plus G, that's a D4, right, over R minus G, right? So we have the 1.59, you solve on the times 3, right? Times 1 plus 5%, right, 1.05, over what? R minus G, right, equal to $11.13, right? If you guys are, sitting at the times race, right, you look forward, right, what's the price you're willing to pay for the stock, right? If you're standing here, right, will be what? $11.13, right? But don't forget, right, this is only for this part, right? We're still not including the dividends you paid, right, and the first 3 period yet, right? So let's take all this stuff together, right? We know our P3, $11.13, right, for this part, right? And we now also combine all the previous dividends you're not included yet, right? So we will discount what? Discount all the, price and dividend, right, to what? To the time 0, right? So P3 you solved for this part, right? And also the first 3 dividends you will discount to time 0, right? So all these cash flows will combine into the time 0, right? Use our discounting rate 20%, right? You can solve our stock price will be what? $9.32, right? So this 9.32 is you discount D1, D2, D3, and also P3 back into what? Into time 0, right? So let me write the details down, right? If you want to track the details, will be 1.2 over what? 1 plus 20%, right? That's the, PV of the D1, right? Then the PV of D2 will be 1.38, right, over 1 plus 20%. Be careful, this one should be squared because this is on time 2. Time 3 will be what? D3 plus P3 because both on time 3. Right? D3 equal to what? D3 we solved is 1.59, right? Plus the P3 11.13, both on time 3. So they will do the discounting simultaneously, right? So over what? Over 1 plus 20%. Cubic, right? So if you do the discounting of these 3 terms, right, 3 terms, right, you will get what? You will get the price equal to $9.62 per share, right? So this is D1, this is D2, and this is D3 plus what? P3, right? So that's our calculations, right, for the non-content growth models, right? We will split into the different stage, right? Do calculations, then combine all these numbers up, right, by using our PV calculations. Okay, next one we will study, right, is about what? About something about fundamental analysis and the technical analysis, right? If you go to an investment bank, right, you will read a book called what? Investment Bible, right? So most likely you will study how to do what? Technical tradings, right? However, in our textbook, we not capture this part in detail because not every professor, I think our technical study will be efficient, but this one is actually well wide, accepted in industry, and so that's why we need to study what the difference between the fundamental analysis and technical analysis. And let's see the detail, right?
There are two basic and distinctly different ways to analyze a stock: technical analysis and fundamental analysis. Fundamental analysts believe the market price of a stock doesn't always match the true value of the company that stock represents. Technical analysts believe that the fundamental elements of a stock's value are already accounted for in a stock's price, that prices move in trends, and that historical patterns in the market and in stock prices tend to repeat. To understand the difference, imagine a fundamental analyst, Tom, and a technical analyst, Joe, at a shopping mall trying to decide which store to invest in. Tom goes into each store, studies the product being sold, the layout, the company's financial statements, and then decides whether to buy that company's stock. Tom is looking for the store with the best fundamentals, things like a good product, responsible management, and so on. Joe sits on a bench in the mall and pulls out his laptop so that he can check the stock charts for the various companies. Joe looks to see which company has been performing the best based on the price of its stock, and then looks for patterns that indicate a store with a strong upward trend. In this case, Joe does not consider the store's products or its financial situation, but instead assumes that these fundamental factors are already factored into its current share price. In fact, Joe doesn't even need to be in the mall to make his choice. Tom will base his decision on the company itself and his belief that it is, or soon will be, worth more than its stock price suggests. Joe will buy a stock because historical trends suggest the price is likely to go up, not because of anything he sees in the company itself. In the end, Tom and Joe may choose to invest in the same store, but their reasons for investing will be very different.
Okay, so I think in this Investopedia video, right, show the difference between the fundamental and technical analysis very good, right? So I will not go to detail to describe the difference, right? But for this course, we want to check how can we use what fundamental analysis and technical analysis, right? So what is fundamental analysis, right? You already see the video, right? So basically for the fundamental analysis, we will look at what? We will look at the financial statement, right? So we will look at the income statement, right? Balance sheet, and statement of cash flows, right? And we will check the performance of this company, right? Either compare with what? Either compare with the same company, but for the previous year, right? We do what? Horizontal analysis, horizontal analysis, right? Or we can do vertical analysis, right? Vertical analysis is from you break down each lines, right, as a percentage of what total assets, right, in a balance sheet, or total revenues, net revenues in income statements, right. So you can either compare with the same company in the previous years, right, use a base year, right, or you can compare the different companies, right, within a same industry, right. So this is a popular study, right, for the fundamental analysis, right. Also, you will study what? You will study something about economics, right. So what's the demand and supply of the products, right, in this company, right? So, and also what's the market share of this company in the total market, right? And also, what's the macroeconomic conditions, right, can be affect this company's performance, right? So everything will be in a what? Fundamental analysis, right? So Warren Buffett, right, is a supporter of this methodology, right? So he used fundamental analysis to choose the best stock, right? That's how he used this method, right? But we also have something called technical analysis, right? As the video shows, right? The technical analysis, we will study the pattern, right? The pattern of the stock price, right? Pattern of stock price in the previous years, right? So you can check the stock price, right? what's the pattern you can find, you can determine what's the future price by looking into the pattern of the stock, right, in the past. So let's say the detail, right, for the technical analysis. Because this one, I think maybe you have some interest, right, more than reading the financial statements, right? So what's the technical analysis? Right, you will check what? You will check the moving average, right? So this one I want to teach you, right? It's called moving average clause rules, right, in technical analysis, right? So if you see a short-term moving average above the long-term moving average, right, this is a very good signals, right? Indicate stock price will increasing in the future, right? Be careful, right? Technical approach will look for the pattern in the past behavior of the stock price, right? This follows stock tradings, right? Also, if you do the currency tradings, right, you will see the exchange rate, right? And we will primarily, based on the history, right? So you assume the history will repeat, right? So what happened in the past will also be happen in the future. That's our technical approach assumptions, right? You assume our market is what? It's not efficient. It's not efficient, right? Everything you see in the past will also happen in the in the future, right? So we assume our market is what? It's not efficient, right? So this one is actually violate, right, our assumptions, right, in our finance course, right? That's why many professors try to not deliver this part. Right? However, this part is actually very interesting, right? Interesting and very useful, right? When you do the trading by yourself, right? This part is very useful, right? Because actually, most markets is not that efficient, right? Because they have, many informations maybe only controlled by the insiders, right? And the public investors maybe has much less information, right, than the insiders, right? That's why the market is not that efficient. For example, how can we use the pattern to capture the good investment point, right? For example, this one, right? So the blue curve is our long-term moving average, right? The black curve is a short-term moving average, right? Long-term moving average is usually forward 200 days moving average, right? And the short-term moving average is for the 50 days, right? What that means? So for every dot on a long-term moving average, we use the total 200 days stop price take our average, and so from the first day, right, second, third, right, until 200 days, right, you get all these days price, right, you take an average, right, 200 days, right, you got the first dot, right, then second dot will be from the second date, right, third date until what, 201st date, right, so you also do an average again, right, so that's a second dot. You keep doing the average price for every 200 days, right, continuously. You got a long-term moving average curve, right? Same thing, right? For the short-term moving average, you got our 50 days average for every dot, right? So if you see the short-term moving average, right, moving very quickly, right, even above the long-term moving average, right, then we call this one as a As a golden cross, right? Golden cross means this one is a signals, right, for you to to buy the stock, right? To buy the stock, right? And it means the stock will appreciating, right? Will be increasing, very soon, right? After you detect this golden cross, right? Golden cross. However, however, if the moving average for short term cross the long-term moving average below, right? Then this one's a death clause, right? Means the stock price will Will going down, right? Going down. So our technical analyst will based on this pattern to find out when is your time to buy the stock, when is your time to what? To sell the stock, right? So let me show you some what? Some examples, right? For example, for this company called First Energy, right? This is a company listed on a New York Stock Exchange, right? We can find out a very good golden cross, right, for this price, right, on the trading market. Right? For example, this is a 50 days, right, short-term moving average, right? This is our what? This is our long-term moving average, right? So 1 hour's short-term moving average close the long-term moving average, right? And this actually signal our what? Signal our golden cross. That means the stock price will moving up quickly. So it's a good time to buy the stock, right? So basically, right, when you are investors on the market, right, suppose you are selling on this day, right? And on the second day, right, you observe, right, you got a pattern like this one, right? Means you are what? You are right to buy the stock now, right? You can get a profit in the future, right? So you can see here, right? After the pink circle, right, you bought this stock, right, you can actually observe, right, the first energy after these pink circles, right, keep going up, right, for a few days, right? It's very strong bullish trend, right? So if you can, detect a good golden cross, right, it will be a very good, right, point to buy a bullish stock, right, to get a high what high return, right, for this stock. And that's for the, golden cross, right? And also we can see these examples for the Facebook, right? It's not just for the golden cross, right? It also has what? Death cross, right? So at the beginning of the 2018, right? So our long-term moving average, right, is below what? Below our short-term moving average, right? And also the short-term moving average even close the long-term moving average in the below, right? So that means it is a death cross. That means our Facebook, right, will be, the price will going down, right, going down, right? During the what? During the late April, right? During late April, actually you can detect the price, right, going down quickly, right, for this part, right, until what? Until the short-term moving average, right, above the what? Long-term moving average, right? So this one shows our what? Shows a golden cross, right? So the price is going up, right? Then you see the short-term moving average cross long-term moving average again in below, right? So that's signal what the price will going down, right? So basically, if you are very good traders, right, you can detecting what the death cross and golden cross, right, to find out, right, when is your time to buy the stock, right, when is your time to what, to sell the stock, right, and what's the time to buy the stock, right, what's the time to sell the stock to reduce what, to reduce the continued loss, right? If you can detect this death clause, you will sell the stock. You will avoid the further loss, right, for this stock. Right? Another patterns, right, in the stock market you can find out is called what? Called head and shoulder patterns. You may heard this one before, right? So if you see the stock price display a trend like a head and shoulders, right? Left shoulder and two right shoulders on the both sides, right? Means this stock will what? Will reverse the trend before this pattern, right? So if the price is moving up after this pattern will going down, right? So the stock will reverse the trend after this pattern detected, right? So let me show the examples, right? For example, right? This is a quote not for stock, right? These examples for the, for the foreign exchange, right? Australian dollars to US dollars, right? So some guys not trading the stock, right? They trading the currency, right? For example, right? And this is Australian dollars to US dollars, right? Means what? Means for one Australian dollars, right, equal to how many US dollars, right? So this is the price of what? The price of Australian dollars, right? So you can see here, for this part, right, Australian dollars price are very volatile, right? Up and down frequently, right? Until, right, the traders observe our head and shoulder patterns displayed, right? One head, two shoulders on the two sides, right? Means the stock price will be reverse the trend. Here's for change, right? Will reverse the trend after this pattern. So from the increasing to decreasing, right? So if you guys are very good traders, right? If you found this pattern, you will sell this currency because you will see the currency will depreciate, right? Then you guys also found another head and shoulder pattern, right? It is a inverse head and shoulder patterns, right? Inverse head and shoulder patterns, right? So you can see the price will be also reverse again, right? From the decreasing to increasing, right? So you can see this is a very classical examples for what? For the head and shoulder patterns, right? If you anytime, right, you detect such patterns by head and shoulder, the price of a stock or a currency will reverse the trend, right, after that, right? For example, right, the head and shoulders must be displayed in total, right? If you saw this pattern, however, for on right hand side, right, you only see, you don't see one shoulders, right? You see more than one shoulders, right? In such case, it is not a head and shoulder pattern. Be careful, right? Then our price will be what? Will be not inverse the trend, right? Only if you see the head and shoulder exactly display such pattern, then the price will be what? Reverse, right? So you must to follow this pattern very, clearly, right? If not, it's not a pattern you will make a decisions, right? Okay, so the last one I want to mention, right, for these chapters, if you don't have the, dividend and growth rate and the return are given, right? In that case, you cannot use our dividend growth model anymore, right? Now what you should do, you can do something, in different way to solve the stock price, right? We can use what? We can use our relative method, right? Relative method means you can use something, right? In a what? In the P ratios, right? The P ratio is the price to the earning ratios, right? So price to the earning ratios, right? If it is given, right? So the price over earning, right, times the earnings per share will be what? Will be the price per share, right? Right, this is cancel out, right? The price will be price per share, right? So for example, if your companies are not public company, right? For example, you're running a what? You're running a, shipping service company, right? Shipping service company, and this company is private, right? Now you try to find out, right? What's the stock price if you go to the public, right? What's your fair stock price, right? However, your company is not in the public, right? You don't have a dividend, right? You don't have what? Return you expected to get. You don't have growth rate of dividends, right? You cannot use our DGM models anymore, right? How can you still evaluate your company? Right? You can use what? You can use a P ratio. What? P ratio can be from your similar companies, right, in your industry, right? For example, for shipping service company, there are so many companies in the public, like the UPS, right? FedEx, and the other companies, right? You use these companies' P ratios, right? Take our average as your reference for your own company's P ratio, right? Then you use what? Earnings per share, right? Earnings is your net income, right? The shares is how many you want to listing into the public, right? And use your earnings per share times the P ratio you got from the public company will be the what? Will be the fair price you want to what? You want to go to what? IPO, right? Initial public offering, right? Initial public offering. If you sell your stock as a new shares into the market, right? How much you want to track is based on these approximations, right? Use your relative companies, right? Times the earnings per share. You will got your price per shares for your company, right? So now let's take a summarize about this chapter, right? In these chapters, we study many different formulas, right? For example, we study the what? One stage model, two stage model, and also dividend growth models, right? The P0 equal to the D1 over R minus G, right? That's our, most popular equations, right? In these chapters, we will see this one in many questions, right? In the homework and test, right? So let's see some details, right? P0, right, is the price on the time zero, right? D1 is the dividends in the next period, right? R minus G. D1 equal to what? D1 equal to D0 times 1 plus G, right? R minus G, right? So in these models, we have several assumptions, right? First, dividend has our compounding patterns, right? So D0 times 1 plus G raised to D, right? G is what? G is the growth rate of dividend, right? And these dividends growth rate are what? Are constant, right? So the D4, for example, is a D3 times 1 plus G, right? Equal to a D0 times 1 plus G raised to 4, right? So the price of the stock at any time, we can do some calculations here, right? For example, P4, right, equal to what? Dividend in the next period, right? Or what? R minus G, right? To be more general, right? More general should be PT equal to the DT plus what? 1 over what? R minus G, right? Next period dividends over what? R minus G for any price of stock on time T, right? Right? So this is our generalized formula for the price on what? On any times, right? So it's the PT. T is the random time, right? Equal to what? Equal to the dt plus 1 over what? Over R minus G, right? Equal to D0 times 1 plus GT, right? Plus 1, right? Over R minus G. Right? That's our more general last, right? Formula for the price of stock at any what? Any time, right? And also try to study the terminology, right, for this one, right? What is the dividend growth model, GGM, right? What's the preferred stock? What's the stock market index, right? What's electronic trading, right? What's the stock quote, right? And that's our formulas, right? That's our formulas, right? And that's our dividend growth models, right? And if you want to solve the R, right? R equal to what? R equal to D1 over the P0, right? Then plus G, right? And D1 equal to what? D0 times what? 1 plus G, right? Over P0 plus G. right? That's how to solve the required of return, right, for the stock, right? Suppose we have dividends and the price and growth rate are given. And also sometimes if you are not with the dividends and the required of returns are given, you can use what? You can use a relative method. Right? Use the P ratio, right, times earnings per share. So what's the most important topics in these chapters? First one, how to solve the what? How to solve the stock price, right? And also, if you want to solve these formulas, right, you want to have our what? Future dividends of the stock, right? That's very important, right, to solve the P0. D1 must be given, right? Or you can use the D0 times what? 1 plus G, right? If a dividend is not given, right, you cannot use this formula, right? And also, issued stock can provide a long-term fundings, right? For equity fundings, right, it will be not matured like the bond, right? So it is for a long-term fundings, right? And our dividend growth model provides us with the help to do what? To do pricing of stock, right? Suppose we have what? Infinite dividend streams, right? So it means dividends will be lasting forever for the stock, right? So we have a common stock have the infinity, dividend streams, right? We use our, DGM model, dividend growth models, right? So let's follow these chapters, right? So in this part two of the lectures, right, we study, the equity market, right? And we also study how to solve the stock, right? If we have the uneven dividend, right? We also study what? Technical analysis, right? And how to use our pattern to find out, right? When is your time to buy the stock? When is the time to sell the stock? When the stock will change the what? Change the trend, right? Will reverse the trend, right? We use our head and shoulder patterns, right? So please let me know if you have any questions for these videos, right? Please comments below our YouTube video and write your comments there.